In this class, we're going to be focusing on the four major types of mortgage lenders. And why this is so important to understand is because this is your first opportunity to start saving money. If we can choose the right type of mortgage lender, it means that we're going to get the lowest interest rate, the lowest fees, and we're going to get the best level of service. So each type of bank is going to have some pros and cons, the good and the bad if we decide to work with them. So I'm here to help you try to understand the different types of mortgage lending options that we have. So there are four major types of mortgage lenders that do the majority of the originations across the country. And whether you're in Mobile, Alabama, or you're in San Francisco, California, the types of mortgage lenders that exist are usually going to be the same regardless of where you're at. The good news is I have actually personally worked for 3 out of the 4 of these types of institutions, so I know them intimately, and I am prepared to kind of give you the secrets of which ones are better for us than most. Starting with FDIC banks, because these are the types of banks that we're most familiar with. So all of us know a Bank of America, a Chase, a Wells Fargo. The great thing about these banks is they are easily accessible. We can walk into a bank, they're going to tell us, yeah, of course we can help you with the mortgage, and they're going to send you to a corner of the bank and you're going to speak with a local banker. The issue with working with some of these types of banks is you're not going to deal with a mortgage expert. So you could be leaving substantial money on the table when not dealing with somebody that knows the different products or the different grants available to you and your specific needs. This should be red flag number one when working with a bank. Also, it's important to understand with a bank how they operate and how they work. When you work with an FDIC bank, someone's going to help you in the corner bank. But then they send the business to what they call regional operating centers. So that means you could be in Sacramento. They're going to take your loan application. You're going to start the mortgage process with them. But then they're going to be shipping your file all across the country into their different bank departments. This can be stressful as a buyer, especially when we're already going through a very stressful transaction. So a lot of the times where we've heard horror stories about bad experiences, or they dropped the ball, or they couldn't miss my closing. A lot of that negative stigma when it comes to the mortgage process is unfortunately for those of us that take the chance and work with a local FDIC bank, such as, again, Wells Fargo or Chase or Bank of America. The issue with these types of banks as well is they're very conservative. And so they're going to ask you for a lot of additional paperwork that other types of mortgage lenders wouldn't. The best scenario when working with a bank, or the people that are most likely to work with these types of banks and get a good deal, are if you are one of the small majority of people that may have hundreds of thousands of dollars in a depository institution with these banks. If, for example, if you work with JP Morgan Chase and you have over $250,000 with them, they'll give you a 1/4 point interest rate. So for example, if today's rate is 5.5, they will offer you a 5.25% because you have over $250,000 liquid with them. The other individual or consumer that may find some benefit working with these types of banks is if you're looking for a jumbo loan. So a loan that's close to $1 million loan amount. A lot of the time these types of banks have aggressive interest rates because they want your larger deposits and they want your business on other sides of lending. Moving on, local credit unions. Credit unions are similar to a bank in the sense that you're not going to work with a designated mortgage professional. However, unlike a bank, credit unions typically have low interest rates and low fees. So if you're already a member at a credit union, it might benefit you to get a quote from your credit union and see what they're offering as far as interest rates and their fees. Moving on to more local mortgage lenders. These are usually segmented into 2 different types of lenders. You're going to have your retail mortgage lender, and then you're going to have your mortgage broker. A retail mortgage lender is, think about Quicken Loans or Rocket Mortgage. This is a retail lender. Retail lenders have local offices all across the country. However, with retail lenders, there's a lot of infrastructure in place, and these individuals will typically only have or only work in mortgages. So the good news is you're going to deal with a mortgage pro. and you're going to get a very high level of service. Typically, these types of mortgage professionals are regionalized, which means your file is not going to be ping-ponged all across the country into different mortgage departments. You're going to be working with a localized team from start to finish. So typically with a retail lender, you're going to have a very high level of service. However, because so many people are just focused on mortgages and they don't have these additional streams of revenue, typically a retail mortgage lender is going to have higher interest rates and higher fees because they're more specialized and the level of service that they provide you is much, much higher. The last option is mortgage brokers. Mortgage brokers are winning more and more of the market share, especially over the last 3 years as interest rates have started to go into an upward cycle. Mortgage lenders are great to work with if you have a very straightforward financial profile or if you need a lot of one-on-one consultation. Just like retail lenders, mortgage brokers are considered local experts in their field. So all they focus on typically is going to be helping people with either a purchase transaction or their refinance needs. The best thing about a broker and the advantage that they truly have is a broker is independent. So they can shop 100, sometimes 200 different types of lenders and bring 90% of consumers the best option when it comes to interest rates and fees. One thing you want to be careful about with brokers is you don't want to deal with somebody who's an inexperienced broker, right? So you want to make sure if you're dealing with a mortgage broker that you understand what's their level of experience. How long have they been in business? How large is their team? How many units or how many home closings are they doing on a monthly basis? So again, mortgage brokers are going to fit 90% of the people out there and be able to bring you the best quote, the lowest interest rates and the lowest fees. And if they have a good team and they do a lot of volume, typically they're going to be able to provide you the same level of service you'd get with a retail mortgage lender. They're going to be able to provide that same excellent type of service. It's important to understand why sometimes as a consumer we see such a large discrepancy or variance when it comes to our interest rate offered from lender to lender. Well, mortgages, just like anything else, are simply a product. So the example that we've decided to correlate it to is a t-shirt, because most of us have bought dozens, if not hundreds of t-shirts throughout our life and have bought them through various channels. So typically, if you're going to buy a t-shirt as the end user, you're going to buy it from two likely places. You're going to purchase it directly from the wholesale distributor, or you're going to purchase it through a shop or local mall. So let's look at the example. If it's a t-shirt, typically it's going to start with a manufacturer. At that point, it passes down to the wholesale distributor. From there, you can purchase it directly from Amazon, where the wholesale distributor is truly making that sale directly to you, or you can go to a mall and buy it from a local shop. What happens when you buy it from a local shop is the product is passing through the hands of multiple middlemen. And so what happens to the price of the t-shirt? If you buy it directly from Amazon, you're going to get that t-shirt for $15 or $16. If you buy that same t-shirt at a local mall, well, they have a bunch of overhead that they have to cover and build into that price of the t-shirt. They have salaried employees, they have managers, they have to also pay the payroll and again cover rent and other overhead. So what does that mean for the cost of your t-shirt? You're likely going to pay closer to $20 to $25 for the same exact t-shirt. Well, loans are no different. It always starts with an investor or what's called a wholesale lender. They offer the products or the mortgages directly to all of the major lenders out there. And so what ends up happening if you decide to use, for example, a retail mortgage lender, is the retail mortgage lender has a lot of overhead. When you go to a retail lending office, you're going to deal with a loan officer. But above that loan officer is typically going to be a branch manager. Above the branch manager is going to be a regional manager, and above the regional manager is going to be a divisional manager. And above the divisional manager is a board of executives. And what happens to your mortgage when all of those people have to make a piece off the top? Your mortgage becomes more and more expensive. So what does that really mean? Your interest rate goes up and your lender fees typically are much more expensive from these types of lenders. Now, let's show the same exact example, but with a mortgage broker. It starts with the same wholesale lender. It's directly to the mortgage broker, and you deal directly with the mortgage broker. So let's do the same exact example, but with a mortgage broker. It starts at the top with an investor or wholesale lender. They pass the product or the offering directly to the mortgage broker. The broker passes the offering or the mortgage product directly to you as the consumer. So, what does this really mean? This means no extra middlemen for you to pay throughout the process. So, that will typically mean lower interest rates and lower fees. Okay, so we're at the part of the course where hopefully you started to understand what type of lender is going to best meet your needs. And of course, what type of lender is most likely to give you the best deal possible. If for whatever reason you're confused or you're on the fence or you don't know what type of lender that you should be aiming for, feel free to use our chat. Okay, I will respond one-on-one and you and I can have a conversation and I will give you my guidance on what type of mortgage lender I think will be best suited to meet your needs and of course get you the best deal possible. Now that I've showed you the different types of mortgage lenders, we're going to jump into how to qualify these individual lenders to make sure that they are going to give you the best deal possible. So let's jump right into it. I have prepared a series of questions that you can use to qualify lenders. It's also a downloadable form here in our course so that you can print it out, convert it to a PDF, and save it as you go or as needed. The biggest thing with these questions, as you're going to see, is our major goals are understanding who we're working with. What is their experience? What is their setup? And how many people are we really paying in between? As you can see from the last section, the more middlemen that are involved, the worse interest rate and the higher cost we're going to pay for our mortgage. So, jumping into it. First question, how many years of experience do you have? How many transactions are you personally doing each month? The reason that we ask these core questions again is we're trying to understand who we're working with. If they are just jumped into the business or they do this kind of as a side hobby, just like a lot of realtors, lenders don't do this full time, you want to be very wary of that. You want to work with a seasoned pro that's helping, if not 5 to 10 people, more dozens of people every month purchase a new home. The reason is they're not going to be overly concerned with making as much money as possible on every single one of your transactions. They're going to be much more likely to help you throughout the process, provide you a lot of value because they do it often. You also want to understand their experience for good reason. If they just jumped into the business or again doing this as a side project, you really don't want to work with those types of folks. If you're okay with the level of inexperience or a high level of inexperience, you want to address it, in my opinion. And how do we address that? Hey, who is your staff? Who is your team? Who is your manager? Can I have your manager's number? The reason is because a lot of the times the mortgage process can be complicated. If something goes wrong, you want to make sure that there is a good team or somebody in place to step in and help overcome the inexperience of the person that you're working with. The next question, how long have you been at your company? Where have you worked before? Why did you choose this company to work with? We're starting to qualify the actual company and the individual. So it's good to understand how long have they have continuity with the team that they're working with currently. That's going to be directly impacting your transaction. So it's important to understand, again, how long these people have been working in their current environment. The next question, would you say you're an expert in my city? Right? So if you're in Austin, Texas. The reason you want to understand this is because the real estate market is hyper localized. If they are a professional and they do a lot of their business in your hometown or the market that you happen to be buying in, they are going to understand the nuances of the deal. And that is super important because in real estate, the details, right, are very, very important. If they say, no, I'm licensed in 50 states and I do business all over the place, that should be a little bit of a red flag. Not that it's not a good thing that they can help you with a different transaction if you decided to move across the country, but it's not ideal that they don't have an expertise in your local market. It's also a lot less likely that listing agents or realtors are going to want to work with a lender that's not local. The next question, will I be working with you from start to finish? And if not, who am I going to be working with? This is really important because a lot of lenders, for example, if it's Wells Fargo or Bank of America, more depository banks, The person that you start the process with is only going to help you through the first few days of the process. Then they will ship your loan off all over the country into different departments, and you'll have a bunch of different people reaching out to you throughout the process. This is a nightmare. If you are purchasing a home, you want to make sure you're working with one person. If they start to tell you about 4 or 5 or 6 different teammates, a red flag should go up. If they can't guarantee that they will be the point of contact from start to finish, my suggestion is to move on to a different lender altogether. Do you have a dedicated operation team? And if so, where are they located? And if not, where is your team located? Again, what we're trying to figure out here is, who are we working with? Where is my loan really going to go? And who's going to be reaching out to me during what could be a 30 or 45-day process? It can be a very frustrating process if the first day it's Joe, and the next day it's Susie, and the next day it's Bob, and so on and so on. So the biggest thing for us is we're trying to narrow down and make sure we are actually working with an expert that's going to provide the value that we expect for the fees and the interest rates that we're paying. Next, let's jump into lender compensation. This is extremely important when qualifying a lender. First question, what is your personal compensation on this transaction? And how many people at your company are being compensated if I decide to close my loan with you? If the answer is more than 3, you should not work with this lender, because chances are you are going to get significantly better service and a better interest rate and better terms if you work with a smaller team. It's just that simple. Let's talk about the compensation. Lenders will typically make their compensation in the form of a percentage amount of the loan amount that they are originating. So for example, the typical standard loan officer origination is 1% of a loan amount. So if they originate a $500,000 loan amount, they will make $5,000. If your loan officer or your lender is telling you that their total compensation is starting to exceed 2% or 3%, again, my suggestion is to move on to a different lender that will do this for a lot less cost. Next, do you receive the same compensation regardless of the loan program that I choose? This is very important because you don't want to work with a lender that is incentivized to push you towards certain loan products. You'd ideally work with a lender that wants what's best for you, regardless of compensation and regardless of the incentives that are tied to these different programs. Most lenders nowadays are set up where the loan officers receive the same flat compensation. However, there are still retail mortgage lenders that get significantly more income or compensation by doing government-backed loans like USDA, VA, FHA, compared to conventional loans that we're more familiar with. Conventional loans for most people are going to end up being the better deal, especially if you have good credit. So just be very wary if someone tells you, no, I make different compensation. If that's the case, you may want to ask, what are the different levels of compensation and what programs are they tied to? Next question. Do you charge me lender fees on every single transaction I complete with you? Most great lenders exist for loyalty, and they appreciate the loyalty of their repeat clients. If this lender is not willing to offer a discount if you were to be a repeat customer, again, my suggestion would be to simply move on. Most good lenders will waive all origination or lender fees after your first transaction. If you cannot get this, especially in this high interest rate environment, my suggestion again is simply to move on. Last question. What does our relationship look like post-closing? Most lenders, 90% of lenders, unfortunately, are going to tell you that they'll stay in touch with you and they'll help you with your needs in the future, but this is where most lenders fall short. The retention rate for lenders is abysmal. It is the lowest across all major industries in the US. So what does that mean? It means that 85% of consumers do not work with the same lender twice. So if you are interviewing a lender, it's important to ask them, what does our relationship truly look like post-closing? If you're going to offer me incentives and you're going to offer me loyalty programs, are you really going to be able to use it if this lender doesn't have a plan in place to stay in touch with you and provide value post-closing? In the link below, you're going to be able to download the questionnaire that we just covered together. you're going to notice there are extra questions on there. Those are for your benefit. The suggestion that I always give to my students is do the full questionnaire with your lender. Okay, it's 15 or 20 minutes well spent, especially if you're considering 2 to 3 different lenders. Do the interview with each one of them, and the questionnaire is going to provide the clarity you need to make the best decision.